Hi folks. Welcome to the most important week of 2023 video. We have a lot to talk about in this video. In my last week video, I mentioned market is looking past inflation and focusing on growth. That's exactly what happened. World stocks rallied and the dollar edged up from 8-month lows on Friday as slowing inflation data raised hopes the Federal Reserve can engineer an economic soft landing and reduce its pace of aggressive monetary tightening next week. U.S. consumer spending fell for a second straight month in December, a Commerce Department report said, which also showed the smallest gain in personal income in 8 months that partly reflected moderate wage growth, both good signs for inflation. Equities have concluded the Fed really knows what they're doing, that they've shepherded the economy pretty well so far and really have a shot at a soft landing. Futures showed the market pricing in a slightly higher peak of the Fed's overnight lending rate at 4.912% in June. The market then sees rates easing to 4.473% in December on expectations the Fed cuts rates later this year. The Fed, however, will be in no rush to cut rates, contrary to what the market perceives. The simple, obvious reason is that cutting rates too soon can ignite another round of inflation and that would absolutely shred their credibility. The yield curve on 3-month Treasury bills and 10-year notes, in the past a solid predicator of a looming recession when yields on the short end are higher, or inverted, than the long end, was at -116.1. Let's begin. Topics for this video. Let's look at the week's performance. SPY and QQQ weekly lows per MI levels. I gave you these supply-demand zones over the last weekend. I had weekly low on S&P 500 at 394. SPY traded up to 408 on Friday, and closed just below my second level at 406. For the QQQ, I gave weekly high as 297. QQQ traded up to 298 on Friday, and closed just below my level at 297. How about that? It's all given for free. So please share and like, so more people can benefit. Also make sure to watch my weekly support and demand video. Now, back to this week's performance. Stocks on Friday recovered from early losses and closed moderately higher. The Dow Jones Industrials posting a 1/2-week high, up 2.5% for the year. With the S&P 500 posting a 6-week high, up 6% for the year. And the Nasdaq soaring to a 4.5-month high, up 11% for the year. The international index is up 1.1% for the week and up 7.8% for the year. Yields are unchanged for the week and down 0.4% for the year. Oil is down 2.7% for the week and down 1% in the year. And lastly, bonds are unchanged for the week and up 3.3% for the year. It was a wild rally on Friday again. So let's take a look at the heat map. Apple is up 5.85%, Amazon is up 5% for the week. Tesla went up a whopping 33.3%, Microsoft up by 3.3%. Growth sector is up. Healthcare sector was weak. The financials are up as well. Let's look at the S&P sector's performance for the week. The growth stocks are up big for the week. Consumer cyclicals up 5.76%, followed by tech up 4.28%. Energy is just 0.5%. And healthcare sector down by 0.72%. Let's look at the sectors for the first month of 2023. Leading again is consumer cyclicals, communication services, and tech. Up by more than 10% for the year. Basic materials are up 9%, following China reopen story. Real estate also up by 8.8%. Financials up by 7.7%. Energy is up by 3.1%. At the bottom are consumer defensive sector down 2% for the month. Fed rates remain at 4.5%. Unemployment at 3.5%. We have FOMC week coming up. Let's look at yields. 1-year Treasury is down slightly since 1 month. 2-year Treasury is down few basis points from month ago. 5-year and 10-year Treasury yields are down as well, which is good for growth and tech sectors. Whereas 30-year Treasury yields are also down now 0.31 points. Mortgage rates. The 30-year fixed is at 6.35%, unchanged from last week and down from last month. The 15-year fixed is down to 5.48%. Let's look at the Fed Watch tool. Next FOMC meeting is in 4 days. Money market participants now see a 99.2% chance the Fed will hike the benchmark rate by 25 basis points in February. And chances for 50 basis points went up from 0% last week to less than 1% at 0.8% this week. For the March FOMC meeting, market participants now see 82% chance for 25 basis points hike. There's a 17% chance that Fed will not change the rate, which is actually down from 20% last week. 50 basis point in March is at 0.7%. Surprisingly, it was 0 last week. Market commentary and some headlines. Cathie Wood's ARK Innovation Fund is closing in on the best monthly performance in its history as it rides a rebound in many of the high-growth stocks that took a beating last year. The $7.3 billion ARK Innovation, ARKK, fund is up slightly more than 25% for the month to date, putting it ahead of the 25% gain it notched in April 2020. The January surge has been fueled by moves of 30% or more in some of the fund's top holdings, including Tesla and Roku. Intel Corp, INTC, saw about $8 billion wiped off its market value on Friday after the US chipmaker stumped Wall Street with dismal earnings projections, fanning fears around a slump in the personal computer market. The company predicted a surprise loss for the first quarter and its revenue forecast was $3 billion below estimates as it also struggled with slowing growth in the data center business. Intel shares closed 6.4% lower, while rival Advanced Micro Devices and NVDA ended the session up 0.3% and 2.8%, respectively. Intel supplier KLA Corp settled 6.9% lower after its dismal forecast. Now let's look at the next week's market momentum or market breadth, and economic calendar and the earnings. Market momentum or market breadth. This is from the Friday's close. It was a pretty good breadth on Friday to the positive side. On NYSE we have 57% advancing issues to 42% declining issues. On Nasdaq we have 56% advancing issues to 41% declining issues. Looking at the moving averages, they all have came down slightly compared to last week. Last week we had 51%, now 64% are above 5-day moving average and 77% above the 20-day moving average. Looking at 200-day moving average, improved from 51% last week to over 57% this week. So the momentum is still positive, it can support the short-term continued rally. But is it approaching over bullish levels? Now let's look at the new highs and new lows. So similar thing here. In the new highs and the lows are more of uptick in the breadth across the board in 5-day, 3 months and 52-week new highs and lows now. Only 25% of the stocks near 1-month highs, and 3% near the lows. So, at least they are holding up well. We still have only 6% stocks above the 6-month high, whereas S&P 500 is almost at 6-month high. This says that we don't have broad rally across the market. Only the few stocks are pushing them higher. Economic calendar for next week. On Monday, we have Call's Fed Manufacturing Index. On Tuesday, we have employment and housing data. We also have Chicago PMI and CB consumer confidence. On Wednesday, we have lot of things happening. We have FOMC rate decision. And in the morning we have ADP non-farm employment, jobless claims, manufacturing PMI and JOLTS data. We will still have 10.2 million of job openings. On Thursday, we get job claims, factory order. On Friday, we get the wages data, unemployment rate, services PMT, ISM non-manufacturing data. Now, let's look at the next week's earnings. We see earnings from some big logos this coming week. On Monday, we have Sophie, H&R Block, Helmerich, and Payne, Sanmina on the deck. On Tuesday, we have ExxonMobil, Pfizer, McDonald's, UPS, AMD on the deck, as well as GM and AMZN. On Wednesday, after the FOMC rate decision, we have Meta or Facebook, Alibaba, Thermo Fisher, Altria. On Thursday, we have the most important earnings of 2023. All trillions-dollar companies. Apple, Google, Amazon. Then Qualcomm, Eli Lilly, Merck, BMY. Also Starbucks and Gilead. On Friday, we have Cigna, Regeneron, and Aon on the deck. That's all in this video. I hope you enjoyed watching this video and learn what to look forward in the upcoming week. Please drop a like, or share, and subscribe. See you in the next video.